Bear market leader? Here's a prime candidate. As you may know, in every bull or bear market, some stocks or sector lead while others follow. So the leadership in the stock market works both ways, in uptrends and down. The rally in stocks since last November has been led by a relatively few big cap tech names like Nvidia, Microsoft, Apple, Alphabet, and Meta. As you may also know, history shows that stocks which lead on the upside often lead on the downside after a market turn occurs. That's why in our publications we're keeping a close eye on the tech sector right now. Another prime candidate as a bear market leader is the banking sector. Indeed, our latest August Elliott wave theorist shows this chart and says, bankers are bullish on investments, but investors are not bullish on banks. Bank stocks turned weak during the Dow's first quarter correction and have failed to recover with it since. While all the major stock market indexes rose into July-August, bank stocks stayed down on the year. Besides sinking stock prices, banks are also grappling with an extraordinarily weak commercial real estate market. As a June headline in the Financial Times noted, U.S. banks prepare for losses and rush for commercial property exit. As the article notes, some banks plan to sell off property loans at a discount, even though borrowers have been making their payments on time. The reason for this is that banks fear more delinquencies in commercial real estate down the road. U.S. banks hold about $2.9 trillion in commercial real estate loans, which prompted the Wall Street Journal to pose this question in July. Is the banking crisis over? We are about to find out. As you might imagine, some banks are more vulnerable than others, and Elliott Wave International has emphasized time and again that it's important for depositors to make sure they do business with only financially sound banks. Because even during a severe economic downturn, some banks will not only survive, but thrive. As a 2022 Elliott Wave theorist said, the first edition of Conquer the Crash noted that depositors would become concerned about bank risks and move their money from weak banks to strong banks, making the weak banks weaker and the strong banks stronger. This is just what happened in 2008-2009. The next financial crisis may be just around the corner. Get timely insights in our big picture focused monthly publications by following the link below this video.